So today we are looking at something very simple. It's consolidated income statement, where we have, of course, a group of companies, subsidiaries could be there, but most importantly, we are looking at a group with an associate. We can actually talk over a group with an associate, stroke what here, a joint venture or a joint investment, because these two are normally accounted in the same way, using what we call IAS 28. IAS 28. So the quantitative threshold, remember, whenever our investment in a company exceeds 50%, more than 50%, that means that we are in control of this investee. And if we are in control of the investee, then that investee becomes a subsidiary. If we were to have exactly 50% investment in a company, 50% means half, exactly half, 50%, then automatically that investee will be called who? A joint investment or a joint venture, right? And then whenever we have 20% but less than 50% investment in a company, between 20 and 50% in a company, that means significant influence. Significant influence will, of course, end up at an associate level. And then anytime we have our investment being less than 20%, less than 20% means what here? That is just a mere investment. That mere investment investee straight away will be taken to our group statements, either as just a mere investment or what we call a financial instrument. So this is quite important for us. And today I would want us to look at something very nice. I would want to share the question here. I would want to share some question with you here. Great. Okay. So that book of ACCA, especially this section, actually, if I were you, I would even print the whole of it. If I were you, I would print the whole of this book. It has got very good questions, even for the other topics. Very good questions. It's a good book. This is a book, if I were you, I would have printed. Even if you're talking of an online class, some things you need physical materials, like past papers. I would really recommend you go for physical. You print them out, you print them out, put them in a file. This book, print and bind. Still loading. Is it raining in your places? Is it raining? Who is staying in a good place that is blessed, which is raining at the moment? It's question number 33. Question number 33. I don't know the page. Just go to question number 33. Go to question number 33. Go to question number 33. Nope. Then it's question, could be 36. Could be question 36. Let's check. Mandar. It has disappeared, right? It has disappeared. One with an associate. Great. Let's do this one. Question number 40. Question number 40, Tyson. 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 Tyson. Are we there? Ladies and gentlemen, are we there? Are we there? Are we there? Are we there? Are we there in question number 40? Great. Thank you so much. Thank you so much. Great. Yes. So now we are told here that consolidated, or rather preparation of question, Tyson, consolidated statement of profit or loss and other comprehensive income. Below are the extracts of profit or loss and other comprehensive income of Tyson, its subsidiary Douglas, and associate Frank as at 31st December 08. Tyson, Douglas, and Frank are public limited companies. The shares are trading outside there. Great. So I can see the income statement items, revenue, all the way up to OCI. All the way up to OCI, you know, we have got our income statement, ladies and gentlemen. This income statement, we have the normal income, which ends here, profit for the year. And then we have got other comprehensive income. Now, you great students of accounting, you great students of accounting, whenever you hear these guys talk of OCI, OCI, what comes to your mind? OCI stands for what here? Other comprehensive incomes. Other comprehensive incomes, what comes to your mind? Other comprehensive incomes, what comes to your mind when they talk of OCI? I can never forget revaluations. Thank you very much, David. Yes. Revaluations. Thank you very much. Remember, initially, people used to revalue assets and they could take the revalued amounts, especially upward revalued amounts, they could take those figures to the profit, right? And then they have this revaluation, in this case here, whatever revaluation, upward revaluation that they have, they make that revaluation amount to be part of what are the profit. Now, two things. You've just revalued assets. This is the carrying value of an asset. I'm revaluing this asset upward there, and then I book something like 20 million, and then I take it up there. When I take it up there, two problems. Number one, the taxman would want a share of what here, the revaluation. Is there any cash flow that came in because of this revaluation? No, it's a fictitious thing, right? So the taxman will not want, or rather we will basically be unfair to who? To the company. The other problem will be these directors used to basically take these revalued, upward revalued amounts, the profit and loss account, to simply window dress their financial statements to create fictitious profits. And once they create this fictitious profit, again, we have another stakeholder called the shareholder who will open his eyes widely and say, if you made this amount of profit, why, give us dividends. So companies were even forced to go and borrow against the law to pay dividends because of what here, some wrongly depicted what here, profits of a company. And that is where they came and they said, no, anything to do with these revaluations, we shall be splitting revaluations and taking them to what we call other comprehensive incomes. Other comprehensive incomes, what we shall from today be calling OCI. From today, we shall be calling this OCI, OCI, other comprehensive income. So the other comprehensive income, ladies and gentlemen, you can see here, other comprehensive income, you can see other comprehensive income is gain on property revaluation, which is net of tax. And then we have total now comprehensive income, which is the summation of what here? The summation of this profit for the year and the OCI, like that. I just wanted to bring that to your attention. OCI is not a big thing as people think. No. You are also given the following information that Tyson acquired 80 million shares in Douglas for 188 million 3 years ago. I love this. 3 years ago. It means I'll not be doing time apportionment. When Douglas had a credit balance on its reserves of 40 million, Douglas has $100 million ordinary shares. So, ladies and gentlemen, could you kindly help me out here? Could you kindly help me out here? Kindly help me out here. We have a company that has bought some shares in another company. I can see a group formation. I can see an acquisition. An acquisition, ladies and gentlemen, we are told in this case here that the company that bought the other, is called here Tyson. Tyson was a big boxer. So Tyson acquired 80 million of Douglas shares. So Tyson acquired Douglas, 80 million shares of Douglas. And remember, Douglas had how many shares in total? 100 million shares in total. 100 million shares in total. 100 million shares in total. We are told here. Douglas has 100 million shares in total. So then 80 over 100, this will translate to 80%. 80%. So even if they never told us, 80% honestly is quite big. This means that Tyson is controlling Douglas. So it means automatically that Douglas is a subsidiary. And this subsidiary, we have got two owners. It's important for you to know that. We have a parent company that has got 80%, and then we have got NCI. NCI in this case that owns what percentage somebody, and controlling interest which owns what percentage here somebody. Yeah, because the two must always add up to 100%. So 80% plus 20% will automatically give us 100%. So this must be 20% like that. It didn't stop there. Tyson in this case here went ahead and acquired another company called Frank. Another company called Frank. What percentage of Frank did we acquire? Ladies and gentlemen, Frank, we are told Tyson acquired 40 million shares in Frank over whatever, in this case here, and they were 100 million in total. So basically, Frank, ladies and gentlemen, we acquired 40 million divided by 100 million. So we acquired what percentage here? 40%. If you multiply this with 100, 40%. So that means that Frank becomes who to us? Frank becomes who to us? If you look at this 40%, it means that Frank becomes an associate. It means that Frank becomes an associate. Thank you so much. 40% is in between 20%, but less than 50%. So this becomes an associate. So, ladies and gentlemen, here, of course, I'm going to use IFRS 10 because I've got what here? I have a subsidiary. And I'm going to use IAS 28 because we have an associate. IAS 28 talks about accounting for associates and joint ventures. And it tells us to do something very simple. To use the equity accounting method. We should use equity accounting method. Specifically, in the income statement, just recognize the profit of the associate. And the equity accounting method, we are told here to recognize. You recognize the profit, and OCI in the statement, in the group statement of profit and loss, in the group statement, profit and loss, and other comprehensive incomes. So simply recognize the profit and the OCI, other comprehensive income, in the group statement of profit and loss and OCI. Recognize the profit and the OCI of the associate or joint venture in the group statement of P&L and OCI. This is the only thing I'm required here to remember. Equity is about profitability. How did the profits of this associate help the group? Help the group. IAS 28, it's equity accounting method, nothing much really, nothing much really. There is one thing that you guys forgot. The duration that we stayed with these particular investments is so important. So like now, Douglas, since we bought Douglas, we've been with Douglas for how many years? We've been with Douglas for how many years? We've been with Douglas for how many years? We are told here, 3 years ago, you can see Douglas, 3 years ago. And then you can see Frank, 2 years ago, 2 years ago. So Douglas is 3 years ago, 3 years ago. This is 2 years ago. I'm happy. Why am I happy? Because I will not be doing any time apportionment in this financial year. In this financial year, this subsidiary was ours from the beginning of the year to the end of the year. So this is more than 1 year. Whenever it is more than 1 year, whenever it is more than 1 year, I'll even draw this emoji for my examiner. Whenever it is more than 1 year, I'll not be taking like times 6 over 12. Times 6 over 12, it's more than 1 year. So no time apportionment. There is nothing which can make me happier more than this. No time apportionment. No time apportionment. Great. Now, if that is the case, ladies and gentlemen, then what I'll do is quite a simple thing. Look at what I'll do here. Look at what I'll do. Look at what I will do. Look at what I'll do. If I'm the one doing this, this is a simple thing. This is quite a simple thing. I will draw the proforma statement. I will draw the proforma statement. So I'll come and mention the name of the group. The group is called Tyson Group. Tyson Group. Tyson Group. Right? Tyson Group. Consolidated. 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 Comprehensive incomes. Comprehensive income. Comprehensive income for the period ended. For the period ending. For period ending. For period ending. For period ending. For period ending. Consolidated income for period ending. Consolidated income for period ending 31st December 08. 31st December 08. Now I'm drawing the proforma. This is how I draw the proforma. I'll simply come here and write everything the way it is, but be a bit generous with space. Be a bit generous with space. So I'm copying everything the way it is there. I'm copying everything the way it is there. I'm copying everything the way it is there. So I'm copying everything the way it is there. So we have revenue. We have cost of sales. Right? Cost of sales. We have gross profit. I'm just copying everything. Kwenda chini, we have gross profit. Gross profit. I'm simply combining and copying everything the way it exists there. So gross profit. From there, we have other expenses. Other expenses. So we have other expenses. Other expenses. From there, we have finance income. From there, we have finance cost. Finance cost. Finance cost. From there, we have profit before tax. Profit before tax. Profit before tax. From there, we have the income tax. Income tax expense. Income tax expense. From there, we have a profit for the year. Profit for the year. Profit for the year. Profit for the year. From there, we have OCI. OCI, the other comprehensive income. So the OCI there, I can see we have a gain on property revaluation. I'll simply call it revaluation. I'll simply call it revaluation. Revaluation. And then we have total comprehensive income now. Lastly, and this total comprehensive income must always be written in capital letters. Total comprehensive income must always be written, total comprehensive income must always be written in capital letters, Total comprehensive income must always be written in capital letters. So let me know whether you guys have been able to really reach where I have reached. I've only copied everything. So don't go to any, after I've known the group structure, I'll always come here. I'll always come there. Great. Now from there, I will then remember one thing, that we have an associate in this group structure. And when you have an associate, you only need to recognize its profits in the group comprehensive income, its profits. So in this case here, come straight away. The good thing with me, ladies and gentlemen, is that I have a very good book. I can come and squeeze this here. I can come and squeeze this a little bit. This is finance cost. Please also do that for yours. Create some space here and talk of what here? Share of associates part. Share of associates part before profit, before tax here. Try to squeeze it there. Try to squeeze it. You can even squeeze it with a different color of a pen. Share of associates profit after tax. And then the same with the OCI. So you talk over share of associates OCI. Here. Please try to squeeze those two lines only. Share of associates OCI. Share of associates OCI. Share of associates OCI. Squeeze it. I don't know whether they're able to do that. Just squeeze it there. And if I'm the one doing this question, if I'm the one doing this exam, I'll always start with this share of associate OCI because it's a free mark. I love this. Thing. Share of associates OCI. It is what I'll start with because I'll only come and take 40%. I hope you guys remember the 40% shareholding in a franc. I'll take 40% times any revaluations that happened in the associate company called Frank. And in the Frank, this company called Frank, you will be able to see gain on property net. You can see Frank, in this case here, the revaluation there was what here? Was 5. The revaluation. So I'll only take 40%. 40% is the group share. 40% of 5. This is normally a free. I love this. I love free marks. They're called low-hanging fruits. So I'll take 40% of 5. 40% of 5. 40% of 5. These are low-hanging fruit. 40% of 5, which is what here, which is 2. Thank you very much, Susan. So I could come and create a column here, the final column for this. So this is 2. And this is a joke. Please don't draw these things for your exam. And I really laugh at you and make you fail. This is a joke. You're just putting it here. For your notes, you can draw it, meaning a low-hanging fruit. Yeah, low-hanging fruit, no sweat. But in an exam, never dare do this. The examiner will frown back at you when you're smiling like that. Right? So 40% of 5. I'll always start from there. This is my smiling point, my low-hanging fruit. They will combine with sweet fruits and they are ripe nicely. They even fall down for you to simply pick up and eat. Very sweet fruits. Right? Great. Now, after that, ladies and gentlemen, now I can start picking up the other things very easily. So we start with revenue. Now, the other thing you're supposed to know, you see this guy has given us 3 columns. He has given us comprehensive incomes of Tyson. He has given us comprehensive income of Douglas. He has given us comprehensive income of Frank. Frank is the associate. This is what he has done. Frank is the associate. He has given us these 3. This is the parent company. This is the subsidiary. Column ya franc ni irrelevant. Column ya associate, we don't consolidate. So if I had a physical paper, I would have struck off this column. Unaigonga kwenda chini kabisa. If column ya franc, when I'm consolidating now, equity accounting method tells us just to do the 2 lines. This line for the associate and this line. So column ya franc, sababu ni associate, unaingua kabisa. Because consolidation is about adding figures of the parent and the subsidiary. Adding figures of the parent and who? The subsidiary. So for instance, revenue, now I will come and take revenue of Tyson, parent 500 plus 150. So 500 plus 150. Like that. Usichukue calculator bado, 500 plus 150. Here we are very lucky because we are not doing time apportionment. We are not doing time apportionment. Could you kindly tell me, why are we not doing time apportionment here? Why are we not doing time apportionment here? Why are we not doing time apportionment? Can somebody tell me? Why are we not doing time apportionment? Can somebody talk to me this morning? Thank you very much. The period since we acquired Douglas is more than 1 year. Is more than 1 year. So no time apportionment. No time apportionment, no time apportionment, no time apportionment, no time apportionment. I'm so happy, no time apportionment, because it's more than 1 year. I remember kwa cost of sales. So katika cost of sales, no, katika cost of sales, yes, katika cost of sales, katika cost of sales, katika cost of sales, I can see 270 and 80. 270 and 80, yeah. I like what Google is also bringing up there, that there was no mid-year acquisition. We never had any acquisitions in between the year. So 270 plus 80. Watch and make it your gross profit. Enda kwa other expenses. So other expenses, ladies and gentlemen, other expenses, ladies and gentlemen, other expenses. So the other expenses, when you kuchukua na kuweka, other expenses, I can see 150 plus 20. Other expenses, I can see 150 plus 120, 150 plus, is it 120 or just 20? 150 plus, 150 plus, other expenses, 150 plus 20, 150 plus 20. You know, certain is real. Utapata mwingine akikwambia sana mwalimu, hapa mbona uzakachukue hizo vitu zikuwe tatu, ati 500 plus 150 plus your franc. We're leaving franc out because of the standard. Standard tells us never to consolidate associates, never to bring in figures of joint ventures here directly. No, we don't do that. All right. Then we have the finance income, So finance income, what are we doing? For finance income, ladies and gentlemen, we are only adding. So finance income, I can see 15 and 10. So finance income, I can see 15 and 10. So finance income, I can see 15 and 10. Then I can see finance cost. So finance cost, ladies and gentlemen, what do we have for finance cost? So finance cost is 20 and a dash. 20 and a dash. Finance cost is 20 and a dash, so plus 0 there. And then I can see share of associates part, very easy. I'll talk of 40%. 40% is our share. This is our percentage holding in Franco, who is the associate here. So 40%, ladies and gentlemen, of the profit of Franco. Is there anybody who is able to see the profit of Franco? Is there anybody who is able to see the profit of Franco? The profit of Franco. Anybody who is able to see the profit of Franco? Ukipata hii, tunakupatia zawadi. Profit of Franco. Profit of Franco. Profit of Franco. Nana amepata profit of Franco. Patapotea. Profit of Franco. Profit of Franco. Patapotea. Profit of Franco. Patapotea. Profit of Franco. Patapotea. Profit. Hiyo utapata hapa sana mwanaweza kusema 15. Profit of Franco sio 15. Profit ya Franco ni 10. Ni profit for the year. Ni profit for the year ambao ni 10. So nasema tu 40% of 10. Thank you so much. 40% of 10. Unakawacha hivyo kutakuwa na adjustment, because remember there is always what we call a write down value of an associate. Associates also lose value. Maybe you could be having one of your associates in Ukraine, which is being bombarded by a great not atomic bomb, bullets left, right, and center, that associate then has to be impaired, has to be written down in terms of value, right? So naacha tu hivyo, unajua utapata mwingine amechukua calculator, anaanza kusmile, anasema sasa ni hii, anaanza kufinya. Bado tuangalia zile adjustments chini pole. However, ukifikiwa na examiner, uambiwe now, you know what, time is up. Ukiambiwa time is up 3 minutes, ufinya vitu kwa calculator, most of them will be correct. That's why it's good for you to take this shortcut. Most of these figures here will be correct. Especially vitu kama hizi finance cost, hizi ni marks ya bure. Hizi. Alafu examiner atasema mwanafunzi ni mwanafunzi mwerevu, kumbe hata uko unajua chochote. Profit before tax itakuja baadaye. Income tax expense, are you able to see the income tax expense? Are you able to see the income tax expense? Are you able to see the income tax expense? We have 25 plus 15. Why are we not saying here 25 plus 15 plus 5? Why are we not saying 25 plus 15 plus 5? Please forgive I'm too much inquisitive. I'll ask you so many questions. Please forgive me for that. Especially when I ask you very simple questions, just forgive me. Know that now age is catching up with me. Why am I not adding that 5 under franc? Why am I not adding that 5 under franc? Oh yeah. It's because franc is an associate. And for associates, what are we required to do? Thank you very much. Asezi, thank you, Emily. For associates, the standard only requires us both in the statement of financial position and in the income statement. The equity accounting method only allows us to put in the profits. That's the growth of the associates in terms of profitability. Only that. It's equity accounting method. It's equity accounting method, equity account, very easy. Thank you so much. So income tax expense. So for the income tax expense, ladies and gentlemen, for the income tax expense, I'll come and pick this 25 plus 15. Income tax expense is 25 plus 15. Profit for the year, I'll know what to do. And then now we go to the OCI. I can see revaluation. These are 3 marks. Like revaluation and the OCI, we have 20 and 10. So for revaluation here, my handwriting is too bad. I'll pray that my handwriting improves. I'll pray so seriously. This needs prayers. So revaluation, again on property is 20 and 10. Revaluation is 20 plus 10 like that. Alafu mimi nakuanga mjanja sana. Mimi najuanga sana group consolidation. I'll end up getting so many marks without knowing even what I'm doing. I know some of these things, most of these things I know the ones that don't need any adjustment. Like this revaluation will not need any adjustment. These two actually free. Even income tax expense, rarely will you get the issue of deferred tax not being given. Even this finance, whatever, rarely. I know here I'll need an adjustment because of what here? The internal sales. Lakini kama nachukizwa additional notes, I can go ahead and say 500, I write there. And then this examiner will give me some of them wrong, but I'll end up getting, say, 4 out of 10. And the 4 out of 10 can make you see places. I'm telling you, as pertains heaven, not KASNEB, as pertains KASNEB, 4 out of 10 will make you, in this case, here, see heaven, yes. Low hanging fruits, heaven in terms of KASNEB, yes. Haya, sasa tuende pole pole, lakini kabla kwanza kusoma notes, ningetaka tuwe na breathing space ya 2 minutes. 2 minutes, you just look at your work. Is your work presented nicely? 2 minutes, tuwe na ka break kidogo ka 2 minutes, just breathing space. Tusikasome pia mbio kama hakuna kitu kingine tena. Thank you so much. You can see it is 6:20, so the 2 minutes are over. Now I believe we are ready to get back and finish this question so that some of you will go back to sleep. Quite unfortunate to have my CFOs, people that I'm really relying on, loving their bed that much. Too bad. Can imagine a CFO 5 years from today. Some of you mtakuwa CFO Safaricom. You're about to do quite a lot. You needed to do quite a lot. You should not like your bed so much, ladies and gentlemen. Never go for low-hanging fruits when it comes to comfort. You'll become poor. You will become poor. You will become poor. You will become poor. Great. So now we continue. So here we are. So we start with the first one. So note number 1 will not affect our income statement at all. We go to note number 3. During the year, Douglas sold some goods to Tyson, an upward sale. Douglas is a subsidiary. Tyson is the father, the parent. None of these goods had been sold by the end of the year. Ladies and gentlemen, these are serious members of the group. These are serious members of the group. I would want you to listen and listen to me very well. When a parent sells goods to a subsidiary or a subsidiary sells goods to a parent, such sales is known as an internal sale and it has to be struck off. You must eliminate it. Why? Because of the serious relationship. This is like husband and wife. No, is that really even close? Like, for example, mother and daughter. Mother and daughter. Or even mother and son. They're very close. There is no way they can ever trade. You know, mother's love is very special, right? Everyone else in this case here, you guys know in this world can run away from you, but your mother will always be there for you, regardless. Your mother will always be there for you. So the point is, ladies and gentlemen, if the mother was to sell some goods to the daughter, then at the end of the day, the mother could recognize in her own financial statements, she'll be remembering, hey, I sold some things to my daughter. But when they sit at the end of the year, they sit as a family trying to reflect the operations that took place in their family business. There is no way, ladies and gentlemen, they'll ever account for these internal transfers, for these internal sales. Any sale within the nuclear family is a fake sale. But now let me ask you a question. What if, for example, my cousin wanted to come and get some things from my shop? Cousin, will you give them things for free or you will sell these things to them? A cousin. Cousin, remember, is not nucleus family. Cousin. So if it's a cousin you sell. Because if you start giving these things here to all your relatives, any relative that come and far, here you sell. That will be a genuine sale. So if you're told, ladies and gentlemen, that Tyson was to sell goods to Frank, who is an associate is your cousin. Cousin, you can never consider that as an internal sale. Cousin, you can't say that's a fake sale. That's a genuine sale. The only sale about tunakataa ni sale within the nucleus family. And nucleus family in group accounts haina mambo mengi ni parent and subsidiary. Parent and subsidiary transactions, hizo lazima eliminate. You must eliminate those ones. So are we together as pertains what I'm calling the nucleus family? Are we together? Nucleus family. For me to even see that we're together really, when we talk of nucleus family in group consolidation, we are referring to who and who. Nucleus family, we are referring to who and who. Nucleus family, we are referring to who and who. Nucleus family, we are referring to who and who. Parent and subsidiary. All the others are not well within the nucleus family. So here, and you will see from your past papers, the examiner cheating you that the parent and associate did business. If parent and associate have done business, please don't cancel that transaction. That is not business within the nucleus family. So here there is a business that took place within the nucleus family, which has to be done which has to be cancelled. So you're told here, during the year, Douglas sold goods to Tyson for 66 million. So this sale is fake. So this 66 million, I need to subtract it from where and where? The 66 million, I need to subtract it from where and where? I need to cancel it from sales, and I cancel it from cost of sales. Yes, from revenue and from cost of sales. Both of them. Both of them. We cancel internal sales, both from revenue and what here from cost of sales. Thank you, and thank you so much. Now, after that, can somebody tell me when there is an internal sale, you've been able to cancel it like that? What else? I can see a very good question there. I can see a very good question there. I'll be able to address it. What else in this case here? What will be the next thing that you guys will think about? What will be the next thing that you think about? Somebody. Whenever there is an internal sale, you think of UPS. Thank you very much. You think of UPS. Thank you very much. So think of UPS, yes. Think of UPS, yes. We think of UPS, yes. We think of UPS. We think of UPS. We think of UPS. So UPS, but you guys have forgotten how to calculate UPS. UPS, thank you very much. So we think of UPS. UPS is unrealized profit, unrealized profit on stock, unrealized profit on stock, UPS. And remember, to get this UPS, we normally take profit margin times the remaining intra-sales. Anytime they want us to get UPS, we normally take profit margin times the remaining intra-sales. UPS is profit margin times the remaining intra-sales. This was a great examiner. I love this examiner so much because he never gave us profit margin. So is there anybody who can calculate this profit margin for us? Is there anybody who can calculate this profit margin for us? Let me give you a minute. Profit margin, 18%. Jackie tells us 18%. Remember, to get profit margin, we'll take the profit over sales. Profit over sales. So profit itself, you write, I will take the sales figure minus the cost of sales, the cost of the sale. So 66 minus 48. All over the sales, which is 66. Remember, it's profit margin for this intra-sale alone, for the intra-sale alone. So this intra-sale, how much profit was earned? 66 minus 48, I'll be able to get the profit out of the sales, the intra-sale, 66. I would want to repeat this again. First of all, I would want to share this with you. You can see, ladies and gentlemen, here, that during the year, Douglas sold some goods to Tyson for 66, costing 48. So the profit here generated will be 66 minus 48, right? So, ladies and gentlemen, this figure here, 66 minus 48, is it 18? This figure, is it 18? 18 over 66. I would not want to put it in decimals because I lose some few metrics, some few decimals. I would want to leave it like this, 66 over, it is 18 over 66. If you want, you can, if you wish, you can cancel by 2, whatever, but that doesn't really make sense at this level. Great, I can get a very good question there. I get a very good question there. I'll be able to address that in a moment. So it's 18 over 66. So first of all, are we okay up to here? Are we okay? It'll give you decimals. It'll give you decimals. I don't want to convert to percentage. Let it remain like that. 3 over 11, that's okay. Thank you very much. Now, ladies and gentlemen, from there we have the next thing here. The remaining intra-sale. When these goods within the group, ladies and gentlemen, we are able to sell them. If we are able to sell these goods, then everything becomes nice. Everything becomes very nice. But if you don't sell them, as I change my battery, if you don't sell them, then automatically there will be a problem. If you don't sell them, then automatically there will be a problem. There will be the concept of what here? Unrealized profits. There will be the concept of unrealized who? Profits. Unrealized profits. Unrealized profits. Remember, we only realize profits by selling goods to third parties. But if you sell goods within the group, and then you as an individual company, you have recognized a profit. Like in this case here, these guys recognized a profit of, was it 12? These guys recognized a profit. These guys recognized a profit. These guys recognized a profit. The one who sold recognized a profit of, was it 18 years? But you see, those goods that we recognized a profit of 18 over are well within the group. They haven't yet been sold. So in the eyes of the entire group, that profit should be booked as what here? Unrealized. And how do we get this unrealized profit on stock? We normally take, in this case, the profit margin, which is 18 over 66, times the remaining internal sale. There's really nothing that had been taken out. There is nothing that had been taken out. We are told in this question, they have told us in this question, they have told us in this question. This is what they have told us, ladies and gentlemen. This is what they have told us, ladies and gentlemen. They have told us here, they have told us here, they have told us here. During the year, Douglas sold some goods to Tyson for 6. None of the goods had been sold by the end of the year. None. So all the internal sale was well within the group by the end of the year. So times 66. So then this will end up giving me what UPS? A UPS of 18. Even if you have to use 3 over 11, you still get what there? 18. So first of all, this UPS, is that okay? That UPS, is that okay? Is this okay? Yeah. So this UPS, where should I take it? Where should I take this UPS? Where do I take this UPS? Great. Cost of sales. So this cost of sales, what do I do with this UPS in the cost of sales? I can see what Mary Gedega is telling me, add it to cost of sales. So add it to cost of sales. Now you great students here, could you kindly combine these two, please? What is minus 66 plus 18? What is minus 66 plus 18? Minus 48, fine. So is there somebody who is seeing the answer to the question that some students are asking? Right? Is there somebody who can see the answer to some question they were asking? Why was I not subtracting here 48 direct? And that is the biggest. If you want to get this thing wrongly, you start imagining that here in the cost of sales, you'll be subtracting the cost of sales of the interest. No. That will really confuse you. The rule is very clear. Any intra-sale, you take the sales figure subtracted from the group revenue and from the what here, somebody from the cost, and then you add the POP to take care of that element of profit, right? So now we continue, ladies and gentlemen. Thank you so much. We continue. So we are told here something very nice, that the group policy is to measure NCI at acquisition at fair value. The fair value of NCI in Douglas at acquisition was 40 million. I don't need this really, this noise. In the income statement, this noise. An impairment test carried out at the year end resulted in 15 million of the recognized goodwill relating to Douglas being written off. That is very important to me. There is a write-down of goodwill. There is an impairment of goodwill. So the impairment loss, what do we do with the impairment loss in the income statement? Where should I book it? In the income statement, where should I book? Where should I book? Where should I book this impairment loss? Do I take it to the cost of sales? Where do I book it? 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 Where do I book this? Most of them are not talking to me. Impairment loss is an expense. It's a cost. It's a cost. Under expenses, yes. Not share of associate, no. Remember, this is goodwill. You know, goodwill is for what? It's for subsidiaries, my great sister Mary. Goodwill is for subsidiaries. So there is no way you'll take impairment of goodwill to associate. Never. So goodwill that has been impaired should never go to the cost of sales, not unless you're told otherwise. Impairment of goodwill can either go to the operational expenses or administrative expenses, and the examiner will guide you. In this case, of course, he never gave us a lot of choice. It has to fall under other expenses here. But when you go to your past papers, you'll be able to see the examiner telling you that put impairment of goodwill under administrative expenses because it falls under what we call administrative review, or take it to the operational expenses. That we shall see. Here, we shall take it to other expenses like that. Great. So after that, ladies and gentlemen, we continue reading these, we continue reading these, we continue reading these. So continue reading these. So what are we told here? We are told, and recognition of impairment losses of 2.4 now relate to the investment in Frank. Who is Frank? Frank, ladies and gentlemen, is our associate. Now, Mary, you can see this 2.4 million now is the one that we learned to the associate. Remember the associate, we took the profit. We took the profit of the associate and took our share. And we are told that this investment in our associate has been impaired by what here? By 2.4, like that. Has been impaired by 2.4. It's our investment that has been impaired by 2.4. So could you kindly, first of all, give me this answer? This answer for the associate, how much am I going to write here? This answer for the associate, how much value should I put here? This for the associate, how much value should we put here? For the associate, how much value should we put here for the associate? I'm being told 1.6. I've always seen students doing a big mistake. You always get students saying that this 40% touches this. It doesn't. 40% ends there. 40% of 10 first, whatever I get there minus 2.4. Whatever I get there minus 2.4, which will give me 1.6 like that. Now, could you kindly come and now give me these other figures very fast? What is my consolidated revenue? What is my consolidated revenue? 500 plus 150 minus 6. Please give me an answer here. Give me an answer here. They want me to repeat this concept. You know, it's an impairment of what here? The associate. It's impairment of the associate. We are told here, and recognition of impairment losses of 2.4 million relating to the investment in Frank. So it means that I should go to, Frank is an associate, I should go to and recognized a profit, which is 4 bob. 40% of 10 is 4 bob. Out of this 4 bob, I'm required here to go and charge that 2.4 from that income. I've taken an income, so subtract that expense of 2.4. So they're giving me figures here. They're telling me consolidated revenue. Why not 40% of 4? Good question. Why not 40% of 4? Normally, if you look at this one, they're telling us Douglas being written off and recognition of impairment losses of 2.4 million relating to the investment in Frank. Remember, they are talking of 2.4 for our investment. For our investment, this investment of 40% that we have in Frank lost value worth 2.4. So already they have taken care of the 40% well within this. Right? To our investment, they're not looking at the 60% who are outside there. No, this 2.4 is relating to our investment, which is exactly what here 40, but I'm not going to share this. I'm not going to share this because the 2.4 loss in value is related to our investment in Frank as the group. It can't be 40% of this 2.4. No, that would be wrong. We are not sharing this with the other 60% guys. These are things that will become clearer as we get along. So they're now giving me these figures. They're telling me 584. Thank you very much, 584. How about the cost of sales? So this is 584. Please give me the cost of sales. The cost of sales. Cost of sales is 270 plus 80 minus this plus 18. 302. So then if that is the case, could you kindly subtract this to give me the gross profit? Please subtract this to give me the gross profit. What are we getting here? 584 minus 302. This gives me 282. Thank you so much. If that is the case, please give me the total other expenses. Total of these other expenses, 285. Total of the 285, right? No, 185. 185. Thank you so much. 185. Great. Give me the finance income. Finance income is 25 and it's positive because it's an income. It's positive because it is an income, remember. And then the finance cost is 20. This I'm supposed to subtract. 20 I'm supposed to subtract. Don't forget this share of associate profit after tax is 1.6 and it's an income. So don't deduct it. So then could you kindly give me the profit before tax? Give me the profit before tax. Give me the profit before tax. So you'll take 282 minus this, plus 25 minus 20, plus 1.6. You give me an answer here. 103.6, 103.6. I would want to confirm this from, thank you so much. I can see many of them are giving me this. So profit before tax is 103.6. How about the income tax expense? This 25 and 15 must be 40, right? 25 plus 15 must be 40. 25 plus 15 must be 40. Thank you so much. That is the income tax expense. Then we have the profit for the year. The profit for the year, what do we have here, somebody? Profit for the year, what do we have here, somebody? Profit for the year, what do we have here, somebody? 63.6, thank you very much, 63.6. And then we have the revaluation. Of course, I can see revaluation here is a positive figure of 30. And then I can see the share of associate OCI, 40% of 5. They're giving me a figure, 40% of 5. 40% of 5, the time limit is 2. 40% of 5 is 2, they're positive, both of them. Meaning that our TCI, the total comprehensive income, will be equal to what? Our TCI, the total comprehensive income will be 95 point what here? 95.6, like that. And then now straight away, the moment you reach there, you're a very bright student. What you need to do is to come and do what here? Smile. Now, I would want to give you another secret. You see, like we have got this step. This one I'm supposed to talk about it off record. Great. Now, if you look at, for example, ladies and gentlemen here, if you look at this ACCA, this is what they told us, that the first thing you need to do whenever you get this kind of a question, the first thing you're supposed to do whenever you get this kind of any consolidation question, always start with this proforma solution. And you're putting nothing, but you're copying down copy the proforma solution. I like this concept. Your proforma solution, you'll never go wrong. Alafu pia, ukienda huku nyuma kabisa, answer zako ziko hapa. Answer zako ziko mahali hapa nyuma kabisa, always unacheki solution. Unacheki solution. So ukija hapa, unacheki solution yako. Unacheki solution yako. Hii hapa, unaona hapa? Preparation of question Tyson. So unacheki paka hii total comprehensive for the year, which is 95.6. Where you should never bother at all is this attributable. Hii hata utaifika hapo, hata siku moja. Never. Even us, we got to know about these things. These are attributable when I'm at my workplace. You know, we deal with group consolidation where I work. We are doing group consolidation for Kenya Breweries, Equity Bank, right? We have a software, very strong software. So I came to know about these things when I was working. When I started working when I took a group accounting role. So ukianza kung'ang'ana na hizi hata ukisoma, ili waste of what your time, you'll never reach there. You'll never reach there. So ladies and gentlemen, it has been a pleasure hosting you this morning. See you in the afternoon for those who are doing advanced management accounting. Bye-bye. Musome kwa bidii, hapana enda kulala. Thank you, bye.